Now on to today's market movers with easy to follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Urio, and today we're looking at one of my favorite topics, and that's the Federal Reserve. Now, the market is currently digesting comments made from Chairman Powell, and we're going to be looking at using 10-year options to either mitigate risk or create exposure to any upcoming policy shifts. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay, you heard the testimony. Everyone heard the testimony. We dissect it. It's what we love to do. It seemed like the market thought he was a little bit more dovish. Do you think that's the case?
Yes, and I think surprisingly dovish to some degree in the sense that given everything that we have going on, it was nice to see that Chairman Powell and his crew was somewhat receptive to what I believe is going to be, let's say, a challenging environment, maybe not so much economically, but at least politically when it comes to tariffs and some of the other things that are going on around the world.
Okay, so let's boil it down then. When he mentioned the tariffs, that was the dovish part, right? Because everything else to me sounded like business as usual. That's the part.
That's true. Now, here's what's interesting about that, though. How do the tariffs play into some of the data points, though, that we all analyze going forward? Earnings comments, too, are obviously in light because of the fact that we do have some of these tariff affecting future company plans. So that's why I believe that at least the respect that Powell gained in looking at these tariffs and being more dovish, that's what the market liked.
The part where he said that he talked to companies and they didn't seem as concerned as I thought he was saying as much as they almost should be, which implicated to me that perhaps he was more concerned. So I agree with you on that. Yeah. Before we dive into our trade discussion, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements will vary. When we price these up, the September 10-year contract was trading around 120.04. Scott.
Well, Jim, looking at the summer trade in the ZN so far, I think we can all agree that looking at the charts, it's upon us. I mean, geez, the ZN is nicely, I guess, settled into a little bit of a range here.
Yeah, 283 to 286.
That's right, pretty much.
Right. Yeah.
I mean, gosh, what a tight spread considering that we have had Fed commentary, we have had economic data points that have kind of, in the past, pushed and pulled the ZN a bit. So today, Jim, I was just punching up a couple of call spreads today, believe it or not, and seeing what maybe had some favorable risk-reward baked into it, given the fact that the market seems like it's kind of quiet right now. So specifically looking at buying the week 1 August 120.5 call spread for about 15 ticks. The trade expires August 3rd, has the ZNU underlying. It risks 234 to make a potential 266. Now, as we price this out, the trade is already kind of in that call spread range, and I believe that as the market kind of pushes and pulls around here, you don't really need too much movement in this call spread to get a nice fill out, just with, say, maybe some bid in the ZN bonds.
If price goes to the top end of that range, this will be a pretty good trade. So I'm not, even though I'm going to go the other way, I don't mind this at all. 4 ticks in the money already, so it's really kind of like you're paying 11 ticks of extrinsic. And I think this is a pretty decent trade. I, however, think there's a potential for it to break out, price to the downside, rates to the upside. So I'm looking at buying the week 1 August 119.5, 119 put spread for 5 ticks. Again, underlying is like 120.04, so this is about a half a point below it. It expires August 3rd, and it really profits if yields go back to about 3%. Let's call it 296 would be the bottom end of this put spread. You like?
Well, I do in the sense that if there's a breakout, it's probably going to be that way.
It's going to move fast.
That's right.
Yeah.
And here's the thing, though. This is the question as you price up these trade examples or punch them up. Is this the breakout or is it the stay trade? Because to me, the market just feels like it wants to settle in here. And given that we only have until the first week of August 3rd exactly, you need a lot of things to happen, I believe, to have that breakout happen. And therefore, I just like saying in that closer range.
You know what's funny is that when you look at our two trades, buying a call spread, buying a put spread, those trades could actually probably live well together as well if you think that if ZN's going to move, correct?
Absolutely. And given the fact that we have an earnings report season that's just now getting going, don't forget that as we see things move around in earnings land, hey, that can tend to move the ZN.
One word answer, earnings season, good, great, what?
Fantastic.
Me too, I agree. Thanks for joining us on Market Movers. I'm Jim Urio, where we are helping to make you a better trader.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.